So let me kick off. So hello to McGill Alumni Global. We've got almost 100 people joining us from in many countries tonight. We've got our staff, David Sincox from Montreal, who's going to do a quick introduction. So thank you all for joining. Tonight is brought to you by the Japan chapter. We're welcome to have you all participate in another great session of academic insights, aka gray matters. Still debates as to whether it's an E or an A, but we'll come back to you. So tonight we're very happy and lucky to have Professor Benjamin Croitoru speaking on personal investing. We have a lot more coming up. We're trying to do it almost every month or every 2 months with professors talking in a very casual setting. So again, thank you all for joining, and so please join in the future. We kind of call it a coffee chat. So it's a little bit more of an interactive experience versus a lecture. So you're welcome to join in. I think the professors are very adept, or you can ask your Q&A at the end. But a lot of it is about the interaction versus a lecture. So let's engage in a meaningful conversation. Thank you. I was only allowed 1 minute. Here, I'm going to pass it off to my good compatriot, David Sincox from Montreal. David, please talk a little bit about MAA and go from there.
Thank you very much. So if you missed it, Ken Gold is the president of the McGill Alumni Association of Japan. I'm in Montreal. My name is David Sincox. I'm the director of our Alumni Relations regional team, and I'm really happy that you've joined. As Ken mentioned, there are people from around the globe tonight. I just wanted to give you a quick update. Around the globe, and in each one of the cities, we have about 220 different volunteers that put on events like this in 70 different regions. And from bringing in experts like Professor Croitoru and like yourselves, alumni experts, we're always interested in hearing from you and inviting you to be part of this process. So if you're thinking of volunteering or thinking of giving back in some way to the university through a speaking engagement, we want to hear from you. And one of the underlying goals in that is to provide continuing education, which is really what you're going to see tonight. That component of personal investing it exemplifies where the Alumni Association wants to be as your partner, your alma mater. We want to be able to give back. So thank you to the McGill Alumni Association of Japan for inviting us and for coordinating this session. Back to you, Ken.
Off to Eddie-san. Eddie-san, you've been chairing all this this committee, so please introduce Benjamin and yourself. And so Eddie-san, we should all offer a congratulations, and Naoki-san, who's also on this call. They are the most recent graduating class of the Japan McGill program. They just graduated a couple of months ago. So hands off to you.
Thank you, Ken, and everybody.
Off to you, Edison.
Sorry that I was showing my note earlier, but thank you for joining this Academic Insight, aka Gray Matter event. My name is Eri Ishimura. As Ken mentioned, I'm a class of 2021 McGill MBA graduate and also MAAJ member. So we had 2 speaker sessions under this Academic Insights last year, and this is the 3rd one and the first one this year. This Academic Insights event is the series in which McGill professors share their latest research and insights on a variety of topics that shape our world, from AI and climate change to entrepreneurship and ethical investing. This event is designed to bring the alumni together and to promote the value of education by featuring new concepts and subjects from some of our favorite McGill professors like Benjamin. So tonight we have Professor Benjamin, Associate Professor of Finance and Associate Dean for Undergraduate Programs at McGill University's Desautels Faculty of Management. He's also the Academic Director of McGill Personal Finance Essentials. So Professor Benjamin will speak about personal investing, what's really important tonight. So this will be about the main principles that are valid anywhere in the world. So this will be interesting topic for all of us. And I'm personally very excited about this session, Benjamin. So before handing the stage over to Benjamin, a couple of housekeeping. So we recommend you enjoy the session with speaker view so that you can view Benjamin's face. And please feel free to send in your questions via chat anytime, but we will have a Q&A session after the professor's speech, so you can ask questions during the Q&A session. Finally, we will post this survey link right after this MC, so we really need your feedback, so please copy the link and take the survey at the end of the session. And we will also have the email address on the chat. It's gonna be to our MAAJ member. So if you have any question, you can email that to the email address as well. So without further ado, let's welcome Professor Benjamin, today's professor for the academic insights.
Good evening. So it's a little weird for me to say, I'm trying to convince myself to say good evening. It's a little difficult at 7 a.m. in Montreal. So you can tell I'm talking to you from my home office. And you can see the artwork behind me that I'm very proud of. And well, in a few minutes, my kids are going to wake up, and you'll probably hear them scream at some point. And if you're really lucky, they'll walk into the talk, as they usually do. But then I'm hoping this way they can learn personal finance from a young age, which will help them throughout their life. So as Eri mentioned, I have a number of extra side jobs besides being a professor. And one of them that I'm very proud of is academic director of the McGill Personal Finance Essentials program. And I would say this is a free program that's open to everyone all over the world, a free online course in personal finance that's been funded by the foundation of the Royal Bank of Canada. And it's been a great success with over 200,000 participants in over 2 years. So so you may not need it if you took the MBA Japan and you did well in finance classes, but still you might pick up a few things. And well, you can definitely recommend the program to your family members, friends who maybe we're not fortunate enough to take our finance classes. And so today I'm going to talk about some, I think, relatively basic things, but I think they're still going to be beneficial for everybody. So when I was working on preparing the personal finance course, I had to think, after, I guess, 20 years of teaching finance, what's really important, what's not. And my feeling is that even people who know a lot, well, when you learn about finance and investing, there's so much information that's available, so much to learn, that I think it's easy to lose sight of what really makes the biggest difference and what's interesting, useful, but not nearly as important. So let me try sharing my screen. It seems to work. So yeah, in this talk, I would like to focus on the things that are really important. Of course, I think this is, well, something essential information for anybody who does not know a lot about investing, but I think also for people who have experience, it's a good idea, once in a while to be reminded of what is likely to make the biggest difference. All right. Okay, and the key thing I want to say is that most people think that finance investing is very complicated. And yes, if you want to know everything, do everything that there is to do, it is very complicated. But my opinion is that what makes maybe 80 or 90% of the difference really only takes a few minutes, maybe half an hour to learn. and that's what I'm going to focus on today. And really, the key thing is it's like a version of the oath that doctors take when they start their career, the Hippocratic oath. And apparently, doctors sometimes learn that they're supposed to focus on first, do no harm. And it's like that in investing. I think by far the most important thing to keep in mind is avoid the big mistakes that most people tend to do over and over. So most important thing in investing, be aware of the key mistakes that people tend to repeat over and over. And by just avoiding them, you can do much better than most people. And to avoid the big mistakes, there are 3 rules to keep in mind. We're going to review them, and then I'll add a little bit, but not that much. So I really believe that as long as you keep the 3 rules in mind, yes, there's a lot more that you can learn to make a difference, but most of the extra things do not make a huge difference. And there's really only one big decision, we'll talk about it at the end of this talk, that does make a big difference. So some very, very basics. So I'm assuming most people are familiar with the difference between stocks versus bonds. Stocks are little pieces of ownership in corporations. They're very risky. Bonds are IOUs, basically pieces of paper that are used by institutions to borrow money, basically pieces of paper that represent loans that are relatively low risk, in some cases almost 0 risk. But of course, because of that, they have a much lower return on average. Okay. So most important thing to remember in terms of the menu, the choices that you have as an investor, you have some risky assets, mostly stocks, and some assets that have very low, in some cases, almost 0 risk. Okay. So obviously you can invest yourself, or you can pay a professional to manage your money by buying mutual funds. And most important thing to realize, as far as managing money is concerned, you have 2 basic styles to manage money: active and passive investing. Active investing means you try to do better than the market average. And the sad truth is that most people who try end up failing, end up doing not better and usually worse than the average of the market. Okay, of course there are exceptions, but not that many. So you have active investing that tries to do better than the average of the market, usually unsuccessfully. And you have passive funds that just follow the market, okay, which is boring, but on average does better than active investing. Okay, and of course the big advantage of passive investing, because it's not a lot of work, it's cheaper. The fees, the various expenses that are associated to investing are much lower with passive investing. So what about the 3 rules? And you've probably heard of most of them, especially the first one, which is diversification. Okay, but I'll try to present things in a way that's a little bit different relative to what you may have learned in class. Okay, so let's take a look at these graphs that you see here. What do you have? So you have graphs that show you over 1 year, 1 stock and 1 portfolio, but of course I'm talking about a very specific portfolio here. So I took the example of 2 stocks. Doesn't really matter which one. I wanted one that did better, one that did worse than the index. So look at the top graph. In black, you see the performance of the Apple stock over 1 year. And in beige, you see the S&P 500 index, the average, basically the average of the US stock market over 1 year. Okay. But what I want to stress is that that index, it's not an abstract thing. That index shows you, that beige curve shows you the performance of, well, basically a portfolio that includes the 500 biggest companies in the US, roughly. So that beige curve shows you the performance of a portfolio that's well diversified over 1 year. So on the top graph, you see that Apple did better, significantly better than the diversified portfolio over 1 year. On the bottom graph, you see another stock, Facebook, that did significantly worse than the index, the S&P 500 over 1 year. Right, so you see that some stocks do better than the index, some stocks do worse. Well, that's not very interesting, right? That's what you would expect because the index is basically the average performance of all the stocks in the market. So what I want to show you here, what I want to stress is that, well, if you look at the two curves, they look complete. The two types of curve, right? The black ones and the beige one, they look completely different. The beige curve is a lot more quiet compared to the black curve. Okay, how's that? Why is that? Well, that's the result of diversification. It's simply the fact that when you put a lot of stocks together in a portfolio, the fluctuations that some of the stocks have are going to be offset to a large extent by the fluctuations of other stocks. When some stocks go up in the portfolio, some other stocks, almost all of the time, are going to go down at the same time, and conversely. And as a result, you see that, well, the beige curve is a lot more quiet. You could say it's a little boring, but if you have to choose one type of curve for your portfolio, which one would you prefer? Well, unless you have a very, very strong taste for gambling, well, probably you'd be better off with the beige curve. Okay. So I like this way of showing diversification, and I taught diversification for many years in class in a way that I felt was a little boring, right? Not so convincing. I talked a lot about statistical measures, variance, standard deviations, and then I thought of this way of visualizing things that I think is more, probably more intuitive. Okay, so you see the impact of diversification here, I think, in a very striking way. Most likely, you're much better off with a curve, with a portfolio whose value fluctuates over time, follows a curve that looks like the beige curve here, because, well, you're much less likely to see huge swings in the value of your portfolio in a short time, which means you're much less likely to panic. And you're also much less likely to end up with a catastrophic drop in the value of your portfolio. Okay. All right. Now, if you don't know very well the investing landscape, you might think, okay, so you're telling me here I need 500 stocks in my portfolio. It's too complicated. Unless I'm a multi-millionaire, that's probably not doable. That is wrong. If I was talking about this 50 years ago, indeed, it would have been very difficult to end up with a well-diversified portfolio, one that moves over time, like that beige curve that you see here. The good news is that the financial industry has innovated a lot in 50 years. And now you have index funds that make it very easy to get good diversification by buying a little bit of every stock in the market. And of course, the index funds do that for you. Okay, so I hope I convince you visually with those curves that diversification is a good idea. I want to talk a little more about this, about diversification. I think most people who learn about diversification, and it's again something I think I did not explain enough when I used to be teaching that, diversification reduces the fluctuations of your portfolio on a day-to-day basis, which is great. But diversification also gives you some protection against the bubbles that take place in the stock market once in a while. Okay, so here you have an example of that. So what's a bubble? Well, everybody, I think pretty much everybody has heard of this. And of course, nowadays, you know, with low interest rates, all the money that basically people don't know what to do with all around the world, there are definitely a lot of concerns that there are some bubbles ongoing with different types of assets. So bubbles are something that has been taking place for literally hundreds of years at least. Once in a while, the market goes crazy about one particular type of investment. And in the 17th century, in the Low Countries in Holland, it was tulip bulbs. Well, and then you see on the curve here, around the year 2000, in the US, it was dot-com stocks. Right. So what do you have here? You see between roughly 1999 and 2003, in beige, the S&P 500, the overall US stock market. In black, the NASDAQ stock index, which was at the time basically an index of small high-tech businesses, especially internet-related businesses. Okay, and well, what happened that you see quite clearly in the curve? Over a relatively short period of time, you see that the market became crazy about high-tech businesses, especially internet-related dot-com stocks. You see prices going up like crazy between roughly sometime in 1999 and early year 2000. And then you see the bubble collapsing over the following months. Okay. So one thing I want to stress, so of course, when I talk to my students, my undergraduate students to whom I teach investing, well, they don't remember about this. They were not born in 2000, or they were maybe 1 year old. Now today it's a different audience. I think a lot of you may remember the dot-com bubble around year 2000. But the one thing I want to stress is that when you look at the picture, the curve, 20 years later, of course, it's obvious what had happened, right? It was a stock market bubble, and it looks like, well, you would have to have been stupid to get caught in that bubble and eventually lose a lot of money. But I can assure you that once a bubble is ongoing, it's very difficult to spot because you always have plenty of experts telling you that no, it's a bubble. And I remember very well in year 2000, lots of experts were on TV telling you, no, it's not a bubble. The world has entered a new economy. That's what's going on. This time it's different. So I'm stressing this sentence because when you hear this time is different about some new type of investment or some new trend in the financial market, it means you should be very, very worried. This is the most alarming things. The most alarming sentence you might hear is, this time it's different. Anyway, the point I want to make here, going back to diversification, is that, well, if you look at the curve, you realize that from the peak of the market in year 2000, dot-com stocks lost about 70%, but the market only lost about 40%, which is bad enough, but obviously a lot better than losing 70%. How's that related to diversification? Well, a disciplined diversification strategy means that you will never invest too much in one kind of stock, for example, .com internet stocks. And as a result, it will guarantee that you don't lose in an event like this 70% of your money like many people did. You lose only 40%. Okay, so I think it's a point that's important to stress. Diversification, yes, helps you on a day-to-day basis reduce your volatility. But when a bubble, when an event of this type takes place, a disciplined diversification strategy means that you don't invest all of your money or too much of your money in just one type of stock that may be in a bubble, and that gives you some protection. All right, and then I don't know if there are bubbles going on now. I think I would say that's bubbles, of course, are only easy to spot when it's too late, when they're over. But what I know for sure is that there are going to be bubbles of this type in the future, because it's still, you know, the same human beings with the same psychology, the same human beings as 20 years ago during the dot-com bubble. All right, so I believe I've seen something. I saw one question from Sujit in the chat. Yes, the graphs for the S&P versus Facebook and Apple were prior to COVID. That's correct. That was a few years back, because it doesn't really matter. I just wanted to make, I picked basically some data at almost at random to show the difference between the two types of curves. S&P roughly 18% 1-year growth. What is it recently with COVID? I've not redone the same exercise comparing stocks with the S&P, but I would be fairly confident you would see something similar. For bonds, what is the annual return growth? Well, nowadays it's about basically 0. Well, bonds, we've had basically a very long bull market for bonds between roughly 1980 and now, with interest rates going down over that long period. And of course, interest rates going down means bonds going up. The bad news is that it's over, because interest rates don't have much room to be lower than they are now. So it's hard to imagine good years for bonds in the relatively near future. Okay, let's be hydrate myself a little bit, and let's continue. So I hope I convince you with some graphical evidence of the value of diversification. I think it's more convincing, more spectacular than talking about variance and standard deviation the way it's typically done in the classroom. I'm sorry. Okay. The second rule, and it's advice that looks incredibly stupid, but it's not stupid, but you're going to think, well, rule number 2 is do not buy high and sell low. Okay. And some of you might feel insulted because, of course, it's so obvious. If you buy high and sell low, you're going to lose money in the stock market. So I hope nobody is insulted, because, well, everybody knows that you shouldn't buy high and sell low. You should try to do the opposite. But the reason I'm stressing this is that if you look at the way the typical average investor, I like to call him Joe the average investor, if you look at the way Joe the average investor gets in and out of the market, buys and sells, Joe has a tendency to buy high and sell low. Okay. And I'm going to show you another curve here, an example. So here, you see the US stock market around the global financial crisis, the subprime crisis, between roughly, the curve shows you the market roughly between 2006 and 2013. Okay, so you know what happened. Unlike the dot-com bubble, I'm sure you're all or almost all old enough to remember. At least the main points. So when did Joe, the average individual investor, buy and sell? Well, of course, everybody is different, but I am convinced that lots of people, I'm sure millions of people, well, what did they do? Well, you can see that the market started going down in 2007. But probably Joe, the average investor, well, waited, right? Because people had told him, well, stocks are good for the long run. The stock market usually recovers. So probably when the market started going down late 2007, Joe waited. Okay? And maybe he waited a year or two. But then in late 2008, what happened? Well, for a few months, it really looked like the financial world was collapsing. Okay, and that's what you see, of course, in the picture in the curve. And I mean, I remember very well at McGill, we had the seminar speaker, a very well-informed, competent, intelligent professor from a top university in New York City, who's also part of some advisory board at the Federal Reserve. So one of the most intelligent, best informed experts in the world. And he was telling us it's going to be worse than the Great Depression, which of course did not happen, fortunately. So I think Joe, the average investor, was able to keep his cool for maybe a year or two, but I think many people of this type sold sometime in late 2009. Sorry, late 2008, you know, when the market was really collapsing around that point. And then when did Joe enter the stock market again? Well, I think in many cases for people of this type, it took a few years of seeing stocks go up again until Joe was able to convince himself to get back into the stock market. So of course, every case is different, but I think you have a lot of people who sold around that point in late 2008 and entered the market again, invested again, maybe 2 or 3 years later around that point. Of course, if you do that, well, that's a disaster because compared to somebody who would have done nothing, somebody who would have stayed in the market, would have stayed the course. If you do that, if you buy around that time, sorry, if you sell around that time, you buy around that time, you lose roughly a good 30% of your money. Okay, and 30%, of course, that's not a worst case scenario. It's possible to do much worse than that. Okay, so of course, the best thing to do in a situation like this would be to sell at the highest point and then buy again at the lowest point, but that's impossible. Nobody is able to identify when the market is at the highest point, when the market is at the lowest point. Okay, so the point I want to make here is what was basically the mistake committed by Joe, the average investor. Joe bought and sold based on the dominant sentiment, the dominant mood of the market. Okay, and the problem with doing that is, well, if you follow the mood of the market, when do you sell? Well, you sell when it looks like you know, the financial world is collapsing, when the mood is very depressed, when the mood is really down. And when is that? Well, it's always when the market has been going down for a while. And then if you follow the mood on the market, when do you buy again? Well, you buy when the stock market looks safe, when people have been making money for a while. When is that? Well, of course, it's when the market has been going up for a few years. So almost automatically, if you buy and sell based on the dominant sentiment of the market, You buy high, you buy when you enter the market, you buy when the market has been going up for a few years, and you have a tendency to sell when the market is already down. That's obviously a disaster for your long-term results. Okay, and I think it sounds stupid when I tell you don't buy high and sell low, but I firmly believe this is possibly the costliest mistake that's typically made by individual investors, because they have that tendency to follow the crowd, to follow the dominant mood, sentiment of the market. Okay, and if you do that, well, it's very easy to lose 30% of your money or more, just compared to somebody who would have done nothing, just followed the market. And the bad news is that during your life as an investor, there's going to be more than one crisis of this type, with stock prices collapsing and then recovering. And well, we saw something similar, even though it didn't last that long, and it was less dramatic than with the subprime crisis. Of course, we saw something similar with COVID around March 2020. So imagine during your life as an investor, you experience 2 or 3 big crises like this. You lose 20 or 30% of your money. You lose 30% of your money, even more every time. Well, that's a disaster in the long run. All right. Yeah, but I can see that time is flying. So let me maybe try to finish what I prepared, and then we can talk and discuss questions. Number 3, that's relatively easy. You should watch your expenses. You should know, if you don't already, that active mutual funds typically take about 2% of your money per year in fees. Whereas it's possible to invest passively, while spending a lot less. Mutual funds take very little of your money every year, often less than 0.1%. So if you're not fortunate enough to have studied finance, if you've never done the math, you might think that 2% per year is not a big deal. The bad news is that because of compounding over the long term, 2% per year makes a huge difference in the long term. So you have an example here on the graph. Basically, what's important to remember is that if you invest for the long term, say for your retirement, and you pay 2% per year in fees, in various expenses, it basically divides the money you end up in the long term by 2. Okay? 2% every year consistently over the long term means dividing the size of your portfolio by 2 in the long term. Huge difference. Is it worth paying the 2%? Well, it really depends who you ask. If you ask somebody who wants to sell you something, they are going to try to convince you that it's worth it. If you go see the mutual fund representative at the bank, and I don't want to insult anybody, I think these are, I'm not saying they are bad people. What I'm saying is that these people are basically salespersons, right? They want to sell you financial products, mutual funds. So, well, they might not tell you the truth. Okay, so in the overwhelming majority of cases, it's not worth spending the 2% per year. Okay, in almost all cases, active portfolio managers do not do enough good to offset those 2% per year expenses. Okay, and unfortunately, there's a lot of money that is spent by the financial industry in marketing to separate investors from 2% of their money every year, or even more than 2%. Because of course, well, the 2% are not lost for everybody. They go into the pocket of the financial industry. And that's fair to a certain extent. Okay, the financial industry provides a valuable service to individuals and society. It should make money, but of course, from your point of view as an investor, that's not a reason to give them more than the minimum possible. Okay. All right, so that's the three rules. Diversify, don't buy high and sell low by following the crowd. Watch, and rule number 3, watch your expenses. Now, I tried to show you that ignoring one rule could easily divide your money by 2 in the long run, or even more. Well, because if you don't diversify and you get caught in a bubble, it's easy to divide your money by 2 or even more. If you follow the crowd and you buy and sell at the wrong times around financial crisis, it's easy to lose 30% of more of your money. And remember, as an investor, you will face almost surely more than one crisis in your investing life. And number 3, watch your expenses. I just show you they can easily divide your money by 2. And you know what this means is, well, you have those 3 rules. Ignoring one rule could easily divide your money by 2. Well, what this means is that ignoring all 3 of these rules could easily divide your money by 8 or even 10 over the long term. Okay, so I really, really believe that just these 3 rules can save you a few $1 million in the long term. Well, because basically, just the 3 rules, you know, if you work your whole life, you save money relatively consistently. The 3 rules could make the difference between having a few $100,000 or a few $1 million by the time you retire. Okay, so I hope I convince you, but really listening to me for just a few minutes could save you a few $1 million in the long term. And I really, really don't think I'm exaggerating. Okay, so of course, the 3 rules mean you probably won't be doing very much with your investing. The good news is that research shows, and there's very little ambiguity here, that doing too little is far better than doing too much. Okay, then I promised you, so I think my time is basically up. So yeah, I promised you I was going to talk about the one important decision that makes the most difference. So when you look at, I'll try to go over this very quickly. When you look at what really makes the difference in investing, when you compare people's performance, well, usually it's not really the specific investments that people hold. And the reason is that not many people, most people are not able to pick the right investment, the right stocks. And I'm really not being arrogant here. I'm including myself. I don't know. I mean, I've learned, I think, a few things in finance. Stock picking is not one of them. I don't know how to pick stocks. Okay, despite all these years teaching, learning about finance. Okay, so basically because almost everyone fails at picking the right individual investments, the one thing that explains most of the differences across among people in terms of investment performance is how much do you invest in risky assets like stocks versus safe assets like bonds and cash. Okay, and the classic starting point is that the percentage of risky assets should be 100 or maybe 110 minus your age, which means, of course, that as you grow older and older, you invest less and less in risky assets. And I think it's actually a pretty decent starting point. And the rationale is that when you're young, even if you lose money in the short term, well, you have time to save more to offset these losses. Obviously, if you're older and if you're planning to retire in a few years, you do not have that luxury. So one thing I want to stress is that some people think that it's because stocks always recover from losses in the long term, that you can take more risk when you're young. I really feel that it's not the real reason. I think it's very likely that stocks will recover if they collapse, but I think it's not guaranteed. I think you should take that small, scary possibility that stocks won't recover into consideration in your financial point. Now, the thing I want to stress about this classic rule is that it's only a starting point. You should adapt your policy depending on your personal situation. I'm going to take the example of a person I know well, myself. I personally think that I can invest more than what the rule says. And I see at least, I see a few reasons for this. One reason is that as a professor, I have an unusually safe job, which means I think I can take a little more risk with my financial investments. Another reason is that at this point, I'm planning to retire relatively late. I mean, I like my job. It's not obvious to me I would be happier if I retired. And that means that, well, because I'm planning to retire relatively late, 70, I hope, or maybe a little later, well, that means I have more time to save, and I probably need a little less than most people for funding my retirement. And the third thing is that I've experienced losing money in a stock market crash. I know what it's like, unlike younger investors who are very active and excited these days. I remember the financial crisis a dozen years ago, and I was actually okay with losing money. I didn't panic. I could go. I didn't find it extremely painful. I told myself, well, it's okay. The market is probably going to recover, and even if it doesn't, I'll be okay. I can adjust my consumption without becoming too miserable. Okay, so I have enough experience to know myself a little bit. Okay, so I took this example myself, not because I think I'm incredibly interesting, but because I think these are the kind of things that it's rational to take into account in that decision. Okay, so yeah, I think I'm out of time. So I wanted to talk a couple of minutes about sustainable ESG investing. The one thing I wanted to say is that at this point, a lot of people think that are moving into sustainable investing, and I think it's a good thing. It's having an impact. A lot of people are moving into it because they're hoping to get extra return. I don't think this is rational. Okay, I think the real reason to move into sustainable, ethical, responsible investing is not that you'll get a higher return. The real reason is to hedge against certain types of risk. And of course, that's also a very good reason, make you feel better because you think it's the right thing to do. And I'm stressing this because I think at this point, a lot of people, based on what happened the last few years, think that by moving into sustainable investing, they're going to outperform the market. I don't think it's going to happen. I think a lot of people are going to be disappointed. Okay, so is this a bubble? I'm not sure. I wouldn't really call this a bubble, but it's again an example of, like Joe, the average investor who buys, sells at the wrong time. It's again an example of people looking at the past years, the performance of the last few years, and assuming it's going to continue like that. That's often a recipe for disaster in investing. Okay, so conclusion. Well, the main thing I want to say is that investing is a lot like losing weight. It's simple, but it's not easy. Okay. I mean, losing weight, and I know what it's like. I'm not very good at it. Losing weight is simple because, well, you know that if you eat less and you're more active, you are going to lose weight. There's very little doubt, but it's not easy. And again, I know what I'm talking about. It's not easy to eat less. You need an incredible amount of discipline. Okay, and I've failed most of the time I tried. Well, investing is similar. The 3 rules are relatively simple, but it doesn't mean they're easy. Okay, Why? Well, because when you're in the middle of a bubble and you feel that everybody around you is making a killing in the stock market by buying .com stocks, it's very, very tough to keep your cool, keep a disciplined diversification strategy. It's also very difficult not to sell when you feel that the financial world is collapsing like in late 2008. And it's also very difficult not to overspend in fees because the financial industry is spending billions in marketing in order to make you, well, pay more than necessary in fees. Okay, so remember, the mutual fund advisor at the bank or the stockbroker are not your friends. They're basically salespeople. Okay. All right. So of course, there's a lot more to learn about investing, but I really think everything else is of second order importance. Doesn't mean it's not useful, but I think it will make much less of a difference. Okay, my last slide. Yeah, I wanted to remind you about the personal finance course. It's free online. I mean, it's of course targeted to Canadians, but I think it's potentially useful for anyone all over the world. McGillpersonalfinance.com. Okay, please give it a try. Please recommend it to your friends, families. It's only a few hours of their time, and I think it's a good investment of their time. Okay, so I think I took a few. I'm going to stop sharing my slides, and I know I took a little bit, probably took a little bit too much time, but hopefully I helped a number of you save money in the future. Okay. All right. So yeah, it's my pleasure. No, I really feel. Yeah, I feel I do something good for people when I explain these things, but it can really, because it can really make a difference in your long-term financial security and in the end happiness. All right, so I hope we still have a few minutes for yes.
Yeah, we have a few minutes and we have a few questions. So Tommy.
Yeah.
Yes, Tommy here. You have 6 questions and we have 6 minutes, but I think we still want a little time to close. So I'm going to pick a few of the questions, if that's okay with everyone. So Benjamin, can you hear me?
Absolutely.
Great.
It's always a pleasure.
Same here. So this is on Quinton. What are some criteria for setting sell price targets for individual company stocks that one holds?
Individual stocks that what?
That one holds. Sell price targets for individual company stocks that one holds.
It's a tough one. I mean, with all due respect, like a couple of minutes ago, I think I said, I've learned many things in my 20 years teaching finance. Picking individual stock is not really one of them. So, I mean, you can always compare to other stocks in the same industry. You have simple ratios to do that. But is it the secret of for doing great in investing? I don't think so. Yeah, so I don't have time to explain, this in obviously in a few minutes. But my viewpoint when I teach investment to the students is that what matters most, it's not really the individual stocks who you own, it's the amount of risk that you take. That's what I talked about when I said when I talked about the percentage in stocks versus safe assets. But what matters also is the type of risk. For example, so we don't have time for this, but do you want like basically I'm talking about the big categories of stocks, value stocks versus growth stocks, or I'm talking about one thing that I think could play a role is what about climate risk? Do you want to invest more or less? And it's related to the issue of sustainable investing. Do you want to invest more or less in, for example, stocks that might benefit if climate basically keeps, if the bad news regarding climate keep coming? So I think that's the right way to think. The big risks you're exposing yourself to rather than individual stocks.
Great. It's a problem that we have with this amazing community. All the questions are amazing, so it's really hard to pick one. One question that I see is, do you have some suggested strategies when the market's very volatile, as in these days?
No, honestly, one strategy that has worked well in the past is don't look at the news too much.
Mm.
Yeah, and
Amen.
then at this point, so definitely forecasting, you know, where the market is going. No, nobody can. I really think it's I told you a couple of minutes ago, picking individual stock is very difficult. Most people fail, but figuring out when the market is, where the market is headed in the next few months, the next few years, it's even worse. It's even more impossible to do. So I would say, but yeah, it's still true that by historical standards, stocks are expensive. So maybe at this point, you want to reduce your exposure to stock a little compared to the general rule I talked about. And maybe hold a little more cash. The problem is that if you hold cash now, you're basically losing because the return is less than inflation. So it's tough. So my number one advice is, well, don't look as you're worried about volatility. Yeah, I know it sounds stupid. It sounds like you have a fever, just break your thermometer. But don't look at the news too much because they are more likely to cause panic and bad decisions. Okay. But basically, yeah, if you need your money in the relatively soon because say you're going to retire in a few years, then yeah, you shouldn't have too much in the stock market. You probably need a lot in cash, even though the return is so depressing.
Great, thank you. Again, we have a lot of questions. Benjamin, would it be okay if I share these questions with you and we figure out some way to distribute the answers to the rest of the community? Great, thank you. David, if I can partner with you on this. Syncox, yes, great. And I think with that, we want to close. Eri, are you the one closing this?
Oh, thank you.
Mm-hmm.
So Benjamin, thank you for your time and truly insightful session. I think it's a great reminder for all of us. So when we buy or sell going forward, we have to stop and think about you and think about if we're not stupid, the stupid one that Benjamin mentioned. But thank you very much. It was very interesting. And then
I didn't take it. Sorry, I'm not trying to insult anybody. I'm not talking about stupid people. Basically, what I often say is that when it looks like I'm mocking people, I'm not. I'm basically telling you that even very smart people don't really know what they're doing. So I'm talking about stupid decisions, not stupid people.
Right.
It's different.
Right. Okay. Thank you. So yeah. So this its time will be up. So but this academic insight event we will have the event in March. So stay tuned for the upcoming information. And then I will pass it over to Ken. Ken, do you have?
Thank you, Eddie-san. Really a fun and informative night. Thank you all for attending. Thank you, Eddie-san, for leading this, and thank you, Professor Croitoru, for this speaking on personal investing. So, thank you to Ma, David Syncox. Yes, hello, and to you and your team for supporting us. I mean, you guys are doing a great job in getting us out to the global community. Our purview is to get out to the Japan community. So we're really all part of a McGill community and family. So thank you and welcome to everybody. Thank you to our council members. There's a lot of us on the Japan team. There's a lot that goes behind it. Robert Helt. Yo, Robert.
Hi.
Tommy, Chris, Naoki had to jump off, Sujit, and our gray matter specialist, Eddie-san. Thank you all very much. So now I'm going to hand it off to Robert and or Tommy to close it out. So again, thank you, Professor, for joining it. Oh, one question, simple question. So the artwork behind you, Professor, is that going to go to be an NFT right now?
Oh, you're giving me idea. Well, if anybody wants to buy, you have my email.
Mate, that's what we do. We're innovators. So, okay, off to you, Robert. Tommy, close it out. Thank you.
Tommy, do us the honors. Okay, well, there's nothing really much to add to this. Thank you all for attending. Hope you learned something from this amazing session. Have a good evening, good morning, wherever you are. A great way to start the new year, thinking about investing and how to, make wise decisions. So have a good one and stay tuned for more updates from the team. And please take a minute to attend, take our survey. I think the link was posted on chat. Have a good one. Thank you.
Thank you all.
Thank you.
You.
Bye-bye.
Thank you, everyone.